Welcome to This Explainer. Today, we are putting on our sell-side equity analyst hats to conduct a rigorous fundamental valuation stress test on a highly volatile, heavily debated stock, Rezolve AI, trading under the ticker RZLV. Now, our mission here is simple but absolutely intense. We're going to take the raw financial data, strip away all that market noise, and run this company through a strict gauntlet of fundamental valuation models. We are looking for the intrinsic truth behind the ticker cape.
Okay, let's dive right into this. Here is the strict valuation gauntlet we're running Rezolve AI through today. First, the RZLV challenge, then absolute valuation, DDM and residual income, relative valuation, asset-based limits, and finally, our final verdict. So, starting off with Section 1, the RZLV valuation challenge. Now, to really understand how to value this company, we first have to wrap our heads around the fundamental paradox living right at the center of its financials. It is literally a story of two wild extremes. Just look at this jaw-dropping number right here, 1,480.54%. That is Rezolve AI's trailing 12-month revenue compound annual growth rate. For anyone tracking top-line growth, this is the ultimate bullish, hypergrowth AI narrative. They generated over $53 million in trailing 12-month revenue, exploding out of a multi-year period of basically 0% growth. If you're a momentum investor, you know this number alone is a massive magnet. But here is the sharp pivot. Against that $53 million in revenue, the company posted a trailing 12-month net income of negative $159.26 million. When you actually do the math on that, it yields a staggering negative 3,186% net profit margin. Every single dollar coming in the door is completely dwarfed by the dollars flying out.
So before we begin stressing our valuation models, we really have to establish the baseline market realities we're working with here. The market is currently valuing this company at a market cap of around $945.2 million, with a share price hovering right around $2.37. Meanwhile, the balance sheet shows a current ratio of 0.67, which means short-term liabilities are actually exceeding short-term assets, alongside a debt-to-equity ratio of 0.63. The baseline reality? We've got a company priced near $1 billion that is burning immense amounts of cash with incredibly tight near-term liquidity.
Moving on to Section 2, absolute valuation, cash flows.
This is where we run our very first rigorous test, the discounted cash flow, or DCF model, to find the present value of the company's future cash flows. To build a DCF, we first have to bridge from reported financials to our actual cash generation. We start with that deep net income loss of negative $159.2 million. We adjust for non-cash items, factor in working capital changes, and that brings us to a trailing 12-month free cash flow of negative $87.09 million. The company essentially has a free cash flow yield of negative 9.21%. When your starting cash flow is this deeply negative, a traditional DCF model immediately comes under severe strain.
Now, because our source documents don't provide future management projections, we must step in as analysts and apply clearly labeled external assumptions to force the DCF model to actually output a target. To reflect the extreme risk here, we're assuming a high weighted average cost of capital, or WACC, of around 15%. We'll also assume revenue growth aggressively tapers from its current massive spike down to 50% over 5 years, with a standard terminal growth rate of 3%. But here's the catch. Even with these highly optimistic growth assumptions, discounting years of projected negative cash flows back to present value results in an intrinsic value well below the current $2.37 share price. The math simply requires profitability way sooner than the historical data implies.
Let's look at Section 3, DDM and residual income. Let's see how this builds out. When we apply the dividend discount model, we are inherently looking for mature, cash-generating businesses that are actually capable of sustaining future dividend payments.
So the absolutely crucial point here is that we must completely skip the DDM for Rezolve AI. The source data confirms a 0% dividend CAGR. The company pays literally zero dividends. It has no stated dividend policy whatsoever, and with deeply negative earnings, it has no capacity to pay them anytime soon. The model is theoretically sound, sure, but it is practically impossible to apply to this specific company.
Next up, we test the residual income model. But just look at this data. RZLV has a return on equity of negative 64.53%. The equity charge vastly exceeds any realistic path to near-term net income. Because of that, the model completely breaks under the heavy weight of RZLV's extreme negative metrics, which results in a deeply negative implied intrinsic value.
On to Section 4, Relative Valuation, Pricing Peers. So if absolute models break down, we must turn to relative valuation to see exactly how the broader market prices this specific type of high-risk growth. Now, our source documents do not list identified comparable companies. So to make this model function, we are actively assuming a theoretical external basket of publicly traded AI and high-growth SaaS peers. We take the multiples the market is willing to pay for those peers and hold them right up against Rezolve's current metrics.
And this brilliantly illustrates the total disconnect. Look at these multiples from our data. Rezolve's price-to-sales ratio is a staggering 17.80. Its enterprise value to sales is 18.61. To put that into perspective for you, a typical healthy software company might trade at 5 to 10 times sales. RZLV is trading at an immense premium based purely on that 1,400% revenue growth spike. Meanwhile, earnings-based multiples like EV to EBITDA are negative 8.80 because, well, as we saw, the earnings simply don't exist yet. The market is pricing this strictly on sales momentum and entirely ignoring profitability.
Section 5, Asset-Based and SOTP Limits.
This brings us to our final methodological checks, asset-based and sum of the parts valuations. It's always worth asking yourself, what is the absolute floor here? What if we literally liquidated Rezolve AI today? What is the pure net asset value of the firm if we just sold off the assets and paid down the liabilities?
Well, the harsh balance sheet reality is that high liabilities relative to assets completely crush the net asset value. With a current ratio of 0.67, short-term obligations exceed liquid assets. That means a liquidation scenario offers virtually no protection for equity holders. Furthermore, as an analyst, I have to explicitly note that we must skip a sum of the parts valuation. The provided filings simply do not contain the distinct segment reporting data required to value different business units independently, so we're forced to treat the whole firm as one unified, cash-burning entity.
Section 6, our final intrinsic value verdict. All right, it's time to bring all these analytical threads together for our final sell-side equity verdict. Here you can really see this stark variance in our valuation outputs. On one side, you have a current market price of $2.37, driven heavily by momentum. On the other side, applying traditional absolute models like DCF or residual income to a hyper-growth, highly unprofitable company yields a fundamentally unsupportable, deeply low valuation. The only way you can get even close to justifying the current share price is through highly aggressive relative valuation, banking entirely on the market maintaining an 18 times sales multiple basically forever. So what should you really take away from this explainer? It's this profound tension right here. Does a 1,480% revenue growth rate justify a fundamental valuation black hole? As we've clearly seen, traditional fundamental models say no. The cash burn is just too high, and the negative margins are far too deep. The market, however, is currently betting the entire house on that top-line narrative. The true margin of safety on that $2.37 share price is razor thin, relying completely on the company's ability to somehow pivot from immense losses to sustained cash generation before the market's patience inevitably runs out. Thanks for joining me on this deep dive.